Hello! In this video, we're going to continue with our basis rules, and we're going to focus specifically on determining what is the basis if you convert personal property to gain-seeking property. What is the adjusted basis of that item to depreciate and in the future when you sell it? So recall from our previous videos the big three in terms of our activities: business, investment, and personal activities. And we prefer them in that order when it comes to taking deductions. We prefer business activity first, then investment, then personal, because remember, personal activities, the general rule is that you can't deduct any deductions related to personal activities unless otherwise provided. Business and investment, though, the general rule is you can deduct, but you need to meet special criteria. So let's say that we have a house, and it's a personal house. It's your personal residence, meaning that you don't conduct business in any way with the house, or it's not being rented as an investment. And let's say you buy a bigger house, and you move into that bigger house, and you're debating, okay, should I sell my personal residence, or what should I do with it? Well, one option is you could rent it, and that's exactly what you decide to do. You're going to rent that house, the first house that you have. So now you own two houses. In your original house, you're going to rent. Well, that rental house is almost likely to be considered an investment activity. Remember from the previous videos that business and investment activities are considered gain-seeking. Gain-seeking is business and investment. So now the question becomes, when we go from that personal house, to that rental house, what is the adjusted basis? What is that adjusted basis? Because now, since it's a rental, you can start depreciating. So the first thing to wonder is, now you can start depreciating. The second issue is when you sell it or dispose of the property later, you're going to have a gain or loss. And you need to know that because that's obviously going to be important with respect to that activity. Okay, so the general rule is that you're going to take the lesser of the adjusted basis or the fair market value at the date of conversion. So all the dates that we mention here, unless I specify otherwise, are date of conversion. Conversion being when you switch your activity from personal, the house was personal, to an investment property. That's what we mean by conversion. So again, the general rule is you pick the lower of the fair market value or adjusted basis at the date of conversion. And to determine the adjusted basis at the date of conversion, look at our previous rules. It's probably going to be a cost basis principle. Whatever you paid for the item. And any adjustments for improvements, you can't depreciate your personal property, so you don't have to worry about depreciation or reductions, right? But you're probably going to you might have some improvements that you can, additions that you can increase. All right? That's the general rule. However, there's some special rules. So what I'm going to show you is a little decision tree you can use. And what you're going to notice is that it's very similar rules to the gift rules, the gift adjusted basis rules we learned earlier. What is the adjusted basis of the donee? Very similar little format. Okay? So the first thing we're looking at, again, we're focusing on the date of conversion. If the adjusted basis of the property at the date of conversion is less than the fair market value, you're always going to use the adjusted basis at the date of conversion. At date of conversion. So at conversion. So we always use adjusted basis at conversion. That's for both depreciation and selling the property. Okay? That's for both depreciation and selling the property. However, if the adjusted basis is greater than the fair market value, and we're looking at the date of conversion, then we have to go into the future. And we saw this again with the gift tax rules. So you're seeing this, this is deja vu. And you're exactly right. The first date to worry about is date of conversion, but the second date is when we sell or dispose later. So on the sale or other disposition, when we sell or dispose, we have to look at the proceeds, okay, to determine whether there's a gain or loss. Now, one thing I want to note, at this point, if the adjusted basis is greater than the fair market value. For calculating depreciation, we always use fair market value in this case. You always use the lesser. So depreciation, we always use lesser. So the lesser rule is always used when it comes to depreciation. This cell rule is the special exception. Okay? It's a special exception which we have here. Okay? So the depreciation rule is always the lesser. So if the adjusted basis is less than fair market value, we use adjusted basis. If the adjusted basis is greater, we use fair market value because fair market value is lesser. The special rule we're going to talk about in a moment, when the adjusted basis is greater than fair market value, applies when you sell the property later on. It's very important to understand. So now we're continuing with the sell issue. So the first possibility, the proceeds that are received are greater than the adjusted basis at conversion. If this is the case, then we use the adjusted basis at conversion. And that's even the case, even though fair market value is lesser. Notice that. It's a special rule. Special rule. Adjusted basis at date of conversion. If the proceeds are less than the fair market value at the date of conversion, then we always use the fair market value at the date of conversion. Always use the fair market value at the date of conversion. What if the proceeds are in between the fair market value at the date of conversion and the adjusted basis? So somewhere in the middle here at the date of conversion, at conversion date. What if the proceeds are in between? So they're somewhere in this range. Somewhere in this range. What do you use then? Just like the rules for the gift tax basis, right? Or for the gift basis, what your basis is for income tax purpose, we set the adjusted basis equal to the proceeds. And this results in a zero gain or loss, always. A $0 gain or loss, because your amount realized will be the amount of the proceeds minus your adjusted basis. The amount of proceeds gives you a zero gain or loss. So that's very important. And I'm going to do some examples to highlight this. One thing I want to mention, for all three of these issues, you have to take into account depreciation. Take into account depreciation in determining whether the proceeds are greater than the adjusted basis at conversion. So you subtract away minus depreciation. Minus depreciation. Okay? And then in between, and these are both minus depreciation. You have to take into account the depreciation. Let me test you. Which number are we using to calculate the depreciation? Because this is something in the future, but on date one on conversion, we have to use something to calculate depreciation. That's going to be, if we're here, we're using fair market value. So if we're over here on this area, for depreciation, we use fair market value always. If we're over here, for depreciation over here, we use adjusted basis as well as we use the on the date of sale. See that? Very important. So we subtract away depreciation. It's the amount adjusted basis at date of conversion minus depreciation. Fair market value at conversion minus depreciation. We subtract away depreciation. And the adjusted basis becomes the adjusted basis at conversion minus the depreciation for fair market value. And then this will be set equal to that, so that you don't take into account depreciation here. Okay? This was depreciation. Sorry about that. Take into account depreciation. So let me go through an example now to show you how all of this works, how all of these play together, these rules. Again, I want you to focus. In our examples, assume that you owned a house. It was your personal residence. again, personal activity. You can't take depreciation deductions. You can't take other deductions related to the property because it's not a business or investment gain-seeking property. Business and investment makes up gain-seeking. But then, on a specific date, you convert it to a rental property and you start renting it out as an investment property. So the question becomes, what is the adjusted basis on that date so you can start depreciating, right? And then what is the adjusted basis upon the sale or disposition to take into account what is that amount, okay? So I'm going to have 4 examples. Example 1, 2, 3, and 4. Now this column will be the adjusted basis at conversion, which is CONV. This will be the fair market value at conversion. This will be the amount of proceeds in the future when sold. And this this final column will be depreciation. And for our example, we're going to assume depreciation is equal, even though you might say, hey, how can it be equal? Because you have different amounts here. Just assume for simplicity that it's going to be equal. Let me draw a little, here, let me delineate this. Okay, keep that separate. All right, so let's take a look at the first example. So in the first example, let's assume that our adjusted basis at conversion is $67,000. Okay? The fair market value at conversion is $72,000. The proceeds when we sell the property later on, let's say, I don't know, 8 years in the future. Maybe, we rent it out, we rent out our house, we get rent on it, but then we decide to sell it later on down the road. It's the $72,000, by the way. Sorry, let me make that a little bit clearer. $72,000. The proceeds, when it's sold down the road, $80,000. And the depreciation, this is going to be the same in every, this is going to be the same amount in every year. We're just going to say depreciation every year is $7,000. Okay, just to keep it simple. Again, the numbers are going to change. So you might be saying, hey, that actually would be different, and you would be right. But I'm just going to use the same depreciation amount for all 4 examples, $7,000. Okay, so the first thing you always want to do when you're looking at these items is take into account the depreciation. Just go ahead and subtract away the depreciation. Because when you're looking over here, the depreciation amount needs to be taken into account to determine where you're at in these cases. Over here, you're using the same amount for adjusted basis fair market value, so it doesn't make any difference. So you might as well. So if we subtract away the $7,000 depreciation, we get $60,000, right, after depreciation. We get $65,000 for the fair market value after we take into account depreciation. Proceeds are always going to be that $80,000 number. So I'm going to go ahead, I'm going to put that in the middle. Sorry about that. That doesn't change regardless the amount of depreciation. That's our amount realized. That's what we're getting from the buyer down the road. Okay? So let's put that right in the middle. Okay? Because we don't have to worry about depreciation on that. Okay, so let's go through our tests. So again, the general rule is you pick the lesser of the 2 numbers, which here would be, right, the $60,000. Let's see if it works up here. So we're up here at the first place. Is our adjusted basis less than fair market value? Yes, $60,000 is less than $65,000. So guess what? When we calculate our gain or loss, the proceeds, the amount realized of $80,000, we're going to use a $60,000 number. Okay? Because that takes into account depreciation, which is the basis has been adjusted. So it's going to be, our gain is going to be a $20,000 gain. See that? A $20,000 gain. Amount realized, $80,000. We pick, since our adjusted basis is less fair market value, we pick the adjusted basis at conversion, but we subtract away depreciation. So we take into account the $60,000. So $80,000 minus $60,000 is $20,000 gain. Okay, next example. So in this example, let's assume that the adjusted basis at conversion is $75,000. And let's assume that the fair market value stays at $72,000. Okay? And the proceeds stay at $80,000. So we have to, again, the first thing I always do when I look at this is I go ahead and subtract away depreciation, because if you're going to be over here, it's important. And again, it doesn't make a difference if you're over here. So 75,000 minus 7,000 equals 68,000. So taking into account depreciation, the adjusted basis is after conversion minus depreciation, 68,000. The fair market value, if we subtract away, is the same, 65,000. Okay, so if we apply our general rule, right, the general rule in the code, which says we use the lesser of, we're going to use the fair market value. But hold on, we have to go through our analysis. The analysis that I specified for you, right? The analysis. So first we ask, is the adjusted basis, again, after depreciation, less than fair market value? And the answer to that is no. Adjusted basis is greater, so we're over here. So then we go into the future and we look at sale or other disposition. And that's when we take into account depreciation. And again, for simplicity, I just do the depreciation from the beginning. You can compare this here, 75 or 72, you're still going to get here, right? And 68 and 65 because depreciation is going to be the same amount. Okay, see that? Okay. So we're over here, adjusted basis, 75 or 68, whichever you're using is greater than fair market value, 72 or 65. It's a greater amount, right? Okay, let's stick in this line. Let's just stick with this line. Just take my advice. 68, right? Greater than 65. So we're over here. So now we have to look into the future when we sell it. So down the road, we're getting 80,000 in proceeds. Are the proceeds greater than the adjusted basis minus the depreciation? So the proceeds are 80,000. So here it's important that you focus on the 68, not the 75. If you focus on the 75, you can get this wrong. You end up in one of these other possibilities and you're wrong, right? So the 80, the proceeds, is greater than the adjusted basis of 68. Okay? So we are here. So that means we're going to use the adjusted basis minus the depreciation, right? When we're calculating our gain or loss. See that? That's what we're taking into account. So it's going to be 80,000 minus 68,000 is going to be a $12,000 gain. 80,000 proceeds, amount realized, minus our adjusted basis, which is adjusted for depreciation, 68. That's going to be $12,000 gain. Now notice that when we're determining our depreciation, for depreciation purposes, we use the fair market value because you always use the lesser of the two at conversion, which the fair market value is less. It's 72. See that? So when we calculate that 7,000 depreciation, we're using that amount. See that? We're always using that amount. That's 72. Okay? Here, when we use the 7,000, we use the lesser, which is the 67. That's why I said just assume, okay, yeah, it probably would be a lesser amount of depreciation because you're using 67, but just assume that we're going to keep the same depreciation amount, okay, just for simplicity. This should actually be less, but it's important to understand that, okay, just for simplicity. Okay, so we've determined, again, in example 1, we had $20,000 gain because we used adjusted basis conversion. And again, for depreciation purposes, we use the lesser at conversion, which is 67. For example 2, we use the adjusted basis at conversion minus depreciation, right? But for depreciation purposes, we use fair market value to calculate the depreciation. Okay, example 3. Example 3, also 75,000, adjusted basis at conversion, 72,000 for fair market value, so those stay the same. Proceeds now change, 60,000. So again, I always go ahead and do the depreciation calculation. We subtract away, we get 68,000. Adjusted basis at conversion minus the 7,000 depreciation. Fair market value, right? 72,000 minus 7 is 65,000. So if we're using our general rule, the lesser of, we're going to use the fair market value, okay? But we got to go through the tests, the special rules, okay? So our adjusted basis, 68, is not less than the fair market value. See that? It's not. It's more. So we're over here. So then we go into the future. Are the proceeds 60 greater than the adjusted basis? 68. It has to be after depreciation. 68, not 75, 68. The answer is no. Are the proceeds less than the fair market value at the date of conversion? So 60 Is that less than the 65 fair market value minus depreciation? Yes. So now we're going to use fair market value at conversion minus depreciation. So we use this. So we use 65. So now we have a loss. Our amount realized is 60 minus our $65,000 is a $5,000 loss. If we use the 68, it would have been an $8,000 loss. Notice that this is a provision, right? This rule right here, this is bad for the taxpayer. But look at example 2. If we use the lesser of, we have a $15,000 gain. 80 minus 65 is 15. But actually we use 68, which is 12. So this run right here, example 2, shows you this is taxpayer friendly. This is for the taxpayer. This is good for the taxpayer. But number 3 shows you that this is better for the government. So this is what we call a rule. As the rules, right, when they're applied, actually can potentially benefit both the taxpayer, as you saw in example 2, and the government. See that? Because we have a lower gain in example 2 than using the general rule, and in example 3 we have a lower loss. See that? Very important. Okay, so again, example 3, we picked the we had to use the fair market value minus the depreciation because that we're here in this category, and again for depreciation, we always use the lesser. The lesser would have been the 72, so that's what we calculate depreciation on. Okay, final example. Final example. Assume the same numbers for the adjusted basis at conversion, so 75 and 72, but the proceeds are 66,000. So we must take into account depreciation. It says it right here. We have to take into account depreciation for these items. And this one as well. I just say go ahead and calculate and determine depreciation on it. It's very important to do that. Okay? It doesn't make a difference for this rule. It will stay the same. But when you get over here, it does make a difference. So why not just save yourself some time and subtract away the depreciation? That's what you should be doing first. So we subtract away the 7,000 depreciation. 75 minus 7 is 68,000. Right? 72 minus 7 is 65,000. So we go through our rules. Is the adjusted basis less than fair market value? No, adjusted basis is greater. So we're over here. So for the depreciation purposes, we're using the fair market value to calculate depreciation because it's the lesser. But we're over here in the special rule. So we go down, we look at the proceeds. Are the proceeds greater than adjusted basis after depreciation? Is 66 greater than 68? No. What about the proceeds? Are they less than fair market value minus depreciation? 66, is it less than 65? No. Are the proceeds in between? So the fair market value after you subtract the depreciation is 65,000. The adjusted basis when you subtract the depreciation is 68,000. We're over here in 66. The proceeds are 66. So guess what? This is what applies. We set the adjusted basis, even when you take into account depreciation, to 0. So the gain or loss here will always be 0 when you're in this middle area, regardless of the amount of depreciation. Regardless of the amount of depreciation. And that really goes through everything. Okay? So we're using the proceeds as the adjusted basis. Notice that. So we have amount realized 66, adjusted basis 66, gives us 0 gain or loss. See that? Very interesting. One thing I want to notice, if we did this analysis for number 4, and we did not subtract away depreciation, what would happen? Well, we go through it. It's adjusted basis less than fair market value. No, it's greater. 75 is greater than 72. So we're over here, right? If we don't subtract away depreciation, are the proceeds 66 greater than the adjusted basis of 75? No. But are the proceeds less than fair market value? The proceeds of 66 less than 72? Yes. So if you don't take into account depreciation, we would have actually said we're here, which is wrong. That is not correct. You have to take into account depreciation. Very important. Take into account that depreciation. It's very, very important that you do that. And that's why I think the most important step is always first to subtract away depreciation from the adjusted basis at conversion and fair market value at conversion, regardless the analysis. Because if you don't do it, you're going to end up in trouble, okay? If if you don't do that. I mean, even if you're over here, it still ends up being the same because all you're doing is you're calculating your gain or loss, right? Which you're going to need to subtract away depreciation regardless, and that amount is going to be locked in. See that? Very important. That's something that a lot of instructors, when they teach this, that's a little trick. Always subtract away depreciation first. I'll say it again. Please write this down. Always go ahead and subtract away depreciation. So in our example, right, we start with 67.72, and we have, the adjusted basis at conversion, fair market value. The first thing you should do is take that depreciation, subtract it, and get your adjusted amount. 67 minus 7 is 60. 72 minus 7 is 65. And I did that for every example. It's the first thing I did. Okay. So I want to mention a few things. Again, it's very important to understand the depreciation rule and the sale rule can have different outcomes. The depreciation is always the lesser of. Why? Because that's the general rule and we can't look in the future. This special rule applies when you sell or dispose in the future. So it's always going to be the lesser. So if the adjusted basis is less than fair market value, you use the adjusted basis at conversion to calculate the basis to determine your depreciation deductions over the life. If the fair market value is lesser, you're using fair market value, okay? Even if you're over here, okay? So adjusted basis if you're over here, fair market value if you're over here. Very important. That's for depreciation. But when you sell, it's obviously important to go through this whole analysis. So keep that in mind. Keep that rule separate. For depreciation, it's always the lesser at conversion to determine your amount. It's very interesting because that isn't a rule that's specified in the code or the regulations. It's something that's just a general common law tax theme. Your unrecovered storehouse of capital, it must be recovered, and the general rule says it's a lesser of, so you have to apply the general rule. Okay? It's interesting because, as I mentioned in the gift tax video, when you're trying to determine the basis to use for depreciation, it's not so clear. So please see that video. It's very interesting. I talk about that towards the end of the video, but very interesting concept. That one, it's not as clear. This one, it is. Another thing I want to mention is you saw, again, the taxpayer benefits in example 2 because it was a lesser gain than it would have been if it was a $15,000 if we used the lesser of rule. But again, in example 3, the government gets the benefit because the loss is limited. So the gain is limited to the taxpayer in example 2, but the loss is limited to the taxpayer in example 3, and one's good for the taxpayer and one's good for the government. Okay? The rationale for all this, obviously in example 3, we have a limitation. We have a limitation here. But the ideal, as you see in example 2, is that the depreciation and loss after the conversion, it should be only to the extent of fair market value. And that's what this is all about, especially as you can see in example 3. But to make that work in example 2, that's the only way it can actually work out, to be fair to the taxpayer. So I really hope you enjoyed this video. There's a lot going on here. Please take your time when you watch this. I recommend going through this as I did, writing it out. It will really help you understand it. Take some time, go through it a few times. Go through this video. That's why I do these videos where I write things out, because it helps you understand the steps to not only understand to learn the rule, but also understand the rationale behind it. So I hope you enjoyed this video, and there will be more videos to come in the future.